mentioned. It has been around for 10 years, and according to the Global Impact Investing Network, it says that the industry currently is worth around $500 billion, $50 billion, pardon me, and by 2014 it should be worth around $500 billion. Is it gaining enough traction at this point in time? Are investors starting to be interested in impact investing?
Thank you, Eleni, for having me. And yes, in answer to your question, the Rockefeller Foundation and our partners, including the Global Impact Investing Network, believe that impact investing is a phenomenon that's transforming not only the social sector, but the asset management industry writ large. We see it improving in quality, we see it proliferating both in terms of the number of market participants and in the range of sectors and investment returns that are achievable through impact investments. So in short, we do think it's something that is growing and is poised to grow even farther over the next 10 years.
You mentioned investor returns. Give us an indication of what kind of returns one could get through impact investing, because some say that impact investing is very similar to the likes of private equity funds. But when you look at private equity funds, we do see investors expecting returns of around 20%. What is your view on this, and how can you correlate the two?
It's a great question. It's a question we receive frequently, and it's difficult to make any sort of declarative assessments, in part because a lot of the investments that are being made and the funds that are being raised are quite new. They've closed only in the past couple of years, and as you said, because most of them have 5-7 year lockups, there have not been yet exits in a lot of the funds that we see. But we actually made public yesterday, and we'll be releasing here in Nairobi tomorrow, a joint research report with JP Morgan's Social Sector Finance Unit, where we introduce new data on over 1,100 impact investments that have been made by members of the Global Impact Investing Network. And we benchmark their return expectations, so again, not their realized returns, but their expectations, against benchmarks from standard high-yield corporate debt and venture capital returns, both in emerging markets and in developed markets. And what you see is primarily a variation in return expectations. I think that's the biggest conclusion we can draw, is that these investments are being made at market rates, and in some cases market-beating rates, and in many cases at concessionary rates. But you are seeing in the private equity sort of venture capital space returns ranging from 10 to 15% in their expectation.
Margot,
and where we have data on realized returns, it's only on debt investments.
Margot, also just looking forward, and also for the viewers that don't know what impact investing is, it essentially is investment opportunities that will generate both financial gains for investors as well as create a social or environmental benefit. And a lot of people perhaps say that it's bridging the gap between philanthropy and traditional return-driven investment. That said, many challenges have come to the fore when it comes to impact investing, because one cannot really measure the impact that certain investments will have. And some say it's got to be a hybrid between the likes of environmental impacts and of course of social impacts as well. When you do go to various investors with potential projects, obviously they want to see the metrics and of course the returns and the impact their investment is going to have down the line. How do you deal with this challenge?
That's exactly right, Eleni. Impact investing is what we like to call sort of between the binary of pure philanthropy and purely commercial investment, and it is equally characterized by a financial return and an evidence of a social or environmental benefit. It creates a challenge when we talk about measuring and tracking and rating the non-financial returns. Where you look at financial returns, you can borrow standard metrics from the commercial investment industry, NPV, IRR, the types of metrics that we look at for financial return in our standard investments. And that's not uncomplicated, but it's relatively straightforward. When we talk about social and environmental benefit, it's quite challenging. Often investors are left with looking at the photos on the cover of an annual report, and it becomes very difficult to track non-financial performance over time, to benchmark performance of one investment against others, to have a rating system to begin to situate them against one another. And that's one of the primary challenges that the Rockefeller Foundation, the Global Impact Investing Network, and others are really trying to take on as we attempt to accelerate the development of this industry. It's really laying the groundwork for some of this infrastructure. So, for example, as we have IFRS on the reporting standards for financial performance, we need comparable reporting standards for non-financial performance. And that's a project. I'm sorry, go ahead.
Yeah, Margot, just, we're running out of time, but looking at combining capital from impact first investors and financial first investors, because essentially that's what we need to do down the line as flows start to increase dramatically into Africa, and that is where we really need to start impact investing coming to the fore. What incentive is there out there for investors to embark on this type of investing? And of course, as we say, it's a new asset class, so investors could also start adding this to their portfolio.
Well, what we see is a really broad range of opportunities. You can deposit your cash into institutions that are making community development investments or extending credit to smallholder farmers. You can make more traditional loans ranging from working capital loans to term debt. You can make equity investments, guarantees. There's really a range of investment instruments that are available to impact investors, and there are networks that are forming and syndicates that are forming to help share due diligence, to help reduce transaction costs so that more and more participants can get in on the game.